Hello student, the topic that I'm going to present in this video is the evaluation of financial performance. Users use the financial statement for certain reasons and for decision making. For example, shareholders or owners of businesses are interested in the profit earned, the financial health, performance, and potential growth of the company. Therefore, they can obtain the information needed for their decision making from the financial statement. And managers, for example, they need the financial statement to evaluate the firm's performance for planning, organizing, and controlling the firm's resources. And creditors or lenders are interested in the firm's profitability and in the firm's ability to repay loans. And current and future employees interested to see the performance of a business to determine the monetary benefits that they can obtain from the firm. Meanwhile, for prospective investors, they normally assess the performance of a business in terms of profitability, the stability, growth potentials, and financial health. And customers, for instance, they need to ensure that the company can deliver on not only the goods ordered but also the legal obligations associated with guarantees, warranties, or deferred benefits. And government is interested to see or to use the financial statement to determine the firm's declarations and payment of taxes, fixed price of essential goods and utilities, and also to make expansion plans for the economy. So what is a financial analysis? Financial analysis is the assessment of a firm's past, present, and anticipated future performance. So this analysis is based on firm's financial statement and normally focus on historical performance to estimate future performance. This allows comparison of company's performance over time as well as its performance relative to its competitors. And what are the objectives of financial analysis? The main objective of financial analysis is to identify the firm's strength so that the company can capitalize these strengths and weaknesses so that the firm can take remedial and corrective action. So next is financial ratios. What is financial ratios? Ratios are useful indicators of a firm's performance and financial situations. It is mathematical aids for evaluations and comparison of financial performance and normally used to analyze trends and to compare the firm's financials to those of other firms. So these ratios normally used to tell whether the business is profitable, whether a business has enough money to pay its bills, or could be paying its employees at higher wages, or is paying its share of tax, is it using its asset efficiently, and has a gearing problem. So the objective of ratio analysis is to standardize the financial information for comparison purposes, to evaluate the firm's current operations, to compare the present performance with past performance, to compare the firm's performance with other firms or industry standards, to assess the efficiency of operations, and to assess the risk of operations. So what are the types of comparison? There are two types of comparison, that is internal comparison and external comparison. Internal comparison is the analysis based on comparison of similar ratios for the same firm at different periods. It is also known as time series analysis. For example, comparing this year's profitability with last year's profitability, and the objective is to analyze the financial conditions and the performance of the firm over time. And the second type of comparison is external comparison, where it involves comparison of ratios of a firm with ratios of other firms in the similar industry. This is also known as interfirm or cross-sectional analysis. The objective is to identify the firm's strengths and weaknesses as compared to its competitors. Now let's see what are the types of ratios. Basically, there are five. First, the liquidity ratios. Second, the efficiency ratios. Third, leverage ratios. Fourth, profitability ratios. And fifth, market ratios. So what is liquidity ratios? Liquidity ratios show a firm's ability to meet its short-term financial obligations, and normally two commonly used liquidity ratios are the current ratio or the working capital ratio and the quick ratio or the acid test ratio. Current ratio is the ratio of current assets to current liabilities. The formula is current asset divided by current liabilities. This current ratio indicates the extent to which current liabilities are covered by those assets expected to be converted into cash in the near future. And current assets include cash, marketable securities, accounts receivables, and inventories. Current liabilities consist of accounts payable, short-term notes payable, current maturity of long-term debt, accrued taxes, and other accrued expenses. Assuming that the current ratio is 2 times. This means that the firm has 2 ringgit in current assets for every 1 ringgit in current liabilities. It indicates that the firm has greater ability to meet its maturing obligations. This current ratio is most commonly used measure of short-term solvency. Short-term creditors prefer a high current ratio since it reduces their liquidity risk. Shareholders may prefer a lower current ratio so that more of the firm's assets are working to grow the business. One drawback of current ratio is that inventory may include many items that are difficult to liquidate quickly and that have uncertain liquidation values. An alternative measure of liquidity is to use quick ratio or acid test ratio. So this ratio is calculated by deducting inventories from current assets and by dividing the remainder by current liabilities. So the formula for quick ratio is current asset minus the inventories minus the prepayments over current liabilities. Quick ratio measure the firm's ability to pay off short-term obligations without relying on the sale of inventories. So inventory is deducted because it generally takes longer time to be converted into cash. Prepaid expenses is also deducted because they are expenses that the firm has paid in advance and cannot be used to pay obligations when they come due. Companies with quick ratio of less than 1 will not be able to pay its immediate obligations and therefore should be looked at with caution. So there are a few causes for liquidity problem. Number 1, the company is holding too much stocks. Number 2, poor debtors collection system. Number 3, poor cash management. And number 4, company is using short-term sources of financing to finance the purchase of long-term assets. And there are also suggestions to improve the liquidity positions. For example, promote cash sales or give cash discount. Other than that, a firm may give discounts to encourage early payment, to improve collection system, to adopt effective stock control system, or invest in marketable securities to earn income, and also to reduce current liabilities by paying off the existing creditors or use long-term sources of financing, and finally adopt hedging principles in financing the firm's asset. Okay, the second type of ratio is efficiency ratios. Efficiency ratios, also referred as asset management ratios or asset utilization ratios. It measures how effectively a firm is managing its asset in generating sales, and also show the firm's efficiency in collecting debts as well as turning its stocks into sales. So efficiency ratios comprises of inventory turnover ratio, receivable turnover ratio, fixed asset turnover, and total asset turnover. The inventory turnover ratio, the formula is cost of goods sold divided by the average closing stock. So this inventory turnover ratio indicates how many times the stock is sold and replaced in a year. So if the inventory turnover ratio is equal to 6 times, this means that in 1 year, the inventory is sold and restocked 6 times. The inventory turnover ratio is often reported as the inventory conversion period, which is the number of days worth of inventory in hand. This can be calculated by dividing 360 days with the inventory turnover. An inventory turnover ratio of 6 times means an inventory conversion period of 360 days divided by 6 is equal to 60 days. It implies that the firm is able to sell the inventories within 60 days. This assumption is that in a year there are 360 days. And the possible causes of poor inventory turnover are holding too much stock, that is overstocking. The large portion of stock consists of old or obsolete stocks or damaged stocks, which may be the result of poor stock control system. One of the reasons probably due to lack of sales promotions that lead to lower sales. The firm does not provide trade discount to encourage bulk purchase, or perhaps the firm's pricing policy which affect the demands for the firm's product. So the suggestions to improve the inventory turnover, number one is by evaluating the stock control system and introducing a more effective system or change its present method of ordering stock. Suggestion number two is by cutting down on slow moving and obsolete stock by having stock clearance sale. And the third suggestion is by determining the degree of competitions, whether the product is price elastic or not. Okay, next is the days sales outstanding, and this is also called the average collection period. The average collection period is the number of days that credit sales remain in accounts receivable before they are collected. It represents the average length of time that the firm must wait after making a sale before receiving cash. Also reflect the company's credit policy, whether they are loose or strict. So this average collection period shows the firm effectiveness and efficiency in extending credit and collecting debts. It is also reported as receivables turnover, which indicates how quickly the firm collects its account receivable. So the formula for days sales outstanding, this is measured in number of days. The formula is account receivable divided by annual credit sales over 360. If the days sales outstanding is 40 days, it means that the firm took 40 days to collect cash from their debtor, measured in number of days. And then the receivable turnover, this is measured in number of times. Receivable turnover ratio is annual credit sales divided by the accounts receivables. If a receivable turnover of 4 times imply that the firm is able to collect its debt within 90 days. So the day sales outstanding is the 360 days divided by the receivables turnover. Possible causes of poor debtors collection policy could be due to lax credit policy or poor screening of uh, debtors or accounts receivables. And another possible reason is that no aging of customers' account or no reminders or follow up for late payment, and also could be not enough cash discount given to encourage early payment. So the suggestions to shorten the debtors collection period: number one, adopt a tighter collection policy by doing screening before the credit facility is given to the potential debtors. Secondly, prepare aging of debtors accounts so better control can be enforced on debtors, existing debtors. Number three, screen new customer before allowing them credit sales. This is also part of the title collection policy. And finally, offer cash discount to encourage early payment. Okay. Next is the fixed asset turnover. Fixed asset turnover is the ratio of sales to net fixed asset. So it measures how effectively the firm used its plant and equipment and other fixed asset to generate sales. If a fixed asset turnover is equal to 1.2, this implies that with 1 ringgit of fixed asset, the firm is able to generate 1.20 of sales, so 1 ringgit and 20 cents of sales. The possible causes of low fixed asset turnover and suggestions for improvement. The possible causes of low fixed asset turnover, there are two possibilities. Number one, underutilization of fixed asset, which may be due to too much investment in fixed asset and inefficient use of this asset to produce sales. And secondly, insufficient sales. The suggestions for improvement: the firm may increase productions or dispose of idle fixed assets, and also review the selling price, implement aggressive sales promotions, or give trade discount. Next is leverage ratios. Leverage ratios, also referred as debt management ratios or gearing ratios. Leverage refers to the use of borrowed capital or loans. These leverage ratios measures the level of debt or borrowings in the firm, and it also highlights the ability of a firm to honor its medium and long-term debt commitments in terms of repayment of the principals as well as the interest charges. So leverage ratios comprise of debt ratio and times earned times interest earned. First, we look at the debt ratio. Debt ratio is the ratio of total debt to total assets. It measures the percentage of funds provided by creditors. In other words, it measures how much debt is used to finance the firm's assets. Total debt comprises both current liabilities and long-term debt. So creditors prefer low debt ratios because the lower the ratio, the greater the cushion against creditors' losses in the event of liquidations. If a company's debt ratio is significantly higher than industry ratio, it would experience difficulty in raising additional borrowing. The owners may want more leverage because it magnifies earnings. A debt ratio of 55% means that the creditors have supplied more than half the firm's total financing. And then times interest earned, also referred as interest coverage ratio, ratio of EBIT or earning before interest and tax to interest expenses. Okay, so this times interest earned measures the ability of the firm to meet its annual interest payment. In other words, it measures the extent to which operating income can decline before the firm is unable to meet its annual interest cost. The higher the ratio, the higher the firm's ability to fulfill interest obligations. So this times interest earned of 50.2 times means that the firm's operating income could fall to as little as 1 over 50.2 its current level and still have the income to pay the required interest. The possible causes of high leverage and suggestions for improvement. The only possible cause is high borrowings due to high dividend policy. And the suggestions to improve this high leverage, there are three suggestions. Number one, review the current dividend policy. Number two, finance capital investment from retained earnings. And number three, have optimum mixture in its sources of financing. The fourth type of ratio is profitability ratios. Profitability ratios measure the success of the firm at generating profits. It also shows the combined effects of liquidity, assets management, and debt management on operating result. The profitability ratios measure how effectively the firm uses its asset to make profit and indicate the firm's efficiency in controlling costs and the pricing policy of the firm. And it also shows the profit earned for every dollar of sales made or the profit earned per dollar of investment in asset. The profitability ratios comprise of five um, measurement. Number one is the gross profit margin, and then the operating profit margin, net profit margin, return on assets, and return on equity. The first one, that is the gross profit margin, it measures the gross profit earned on sales. So the formula for gross profit margin is sales minus the cost of goods sold over sales. The gross profit margin is the percentage of each dollar remaining once the company has paid for goods acquired. A gross profit margin of 30% means that the company is making 30-cent gross profit for every 1 ringgit of sales made. A high gross profit margin reflects good earning potential. It also shows the efficiency of the company in controlling its cost of goods sold and the pricing policy implemented. The possible causes of low gross profit margins are insufficient sales volume due to high selling price or higher cost of goods sold, and also higher cost of goods sold may be due to expensive sources in supply of goods, higher labor costs, and high production wastages. And the suggestions to improve the low gross profit margin is to review the pricing policy or to reduce the cost of goods sold by changing supplier and also to reduce the labor cost and production wastage. The next one is operating profit margin. Operating profit is also referred to as earnings before interest and tax, or EBIT. So the percentage of sales remaining after deducting all costs and expenses excluding interest and tax from sales. So the formula for operating profit margin is the earning before interest and tax over sales. The higher the operating profit margin, the higher is the profitability of the company. And the possible causes of lower operating margin are the lower gross profit margin, or high operating expenses, or lower selling price. And the suggestions to improve the low operating profit margin is by reducing the cost of goods sold or reduce the operating expenses or review the selling price. Okay, next one is net profit margin. Net profit margin is the percentage of net income available to common shareholders over sales. The net income available to common shareholders refers to net profit after tax minus preferred dividend. And the possible causes of low net profit margin are high operating expenses and high interest charges. And the suggestions to improve the low net profit margin are by reducing the operating expenses or by reviewing the financing strategies. And then the return on assets or the return on investment. The return on asset indicate the management's ability to make profit from the firm's investment in assets. So the formula of return on assets is the net income available to common shareholders over the total assets. And then return on equity, or the ROE. This ROE, it measures the profit earned by the common shareholders from their investment in the company. The higher the ROE, the better the return for the shareholders. And the formula for ROE is net income available to common shareholders over common equity. And then the last ratio is what we call the market ratios. Market ratios also called investors ratios. So these market ratios relate a firm's stock price to its earnings and the book value per share. It also indicates what investors think of the company's past performance and future prospects. It measures the investors' perceptions and judgment towards the firm's growth potential. So market ratios comprise of the EPS, the dividend per share, dividend payout ratio, the price earning ratio, and dividend yield. First, we look at the earning per share or the EPS. The EPS indicates the profit earned per unit of issued share. So the formula for EPS is the net income available to common shareholders over the number of ordinary shares issued. And a higher value indicates a higher profit per share. The dividend per share indicates the amount of dividend received by ordinary shareholders for each unit of ordinary shares held. So the formula for dividend per share is dividend over the number of ordinary shares issued. The dividend payout ratio. This dividend payout ratio indicates the proportions of earnings that is distributed as dividend to shareholders. Dividend payout ratios for high growth companies are usually lower because most of the profits are spent on reinvestment and expansions. So companies will try to maintain a stable dividend payout ratio. So the dividend payout ratio formula is the dividend per share divided by the earnings per share. And then next is the price earnings ratio or the PE ratio. The price earnings ratio compares the current market price with earnings to establish whether a stock is over or undervalued. It also shows how much investors are willing to pay for the company's earning and measures the investors' confidence in the firm's future prospect. So the PE ratio formula is the market price per share over the earning per share. And then the last one is dividend yield. Dividend yield compares the dividend per share received by the shareholders with the current market price, and it is used to indicate the return earned on shares. So the formula for dividend yield is the latest annual dividend over the current market price per share. The common size ratios, also known as vertical analysis. These common-sized ratios can be prepared from both income statement and the statement of financial position. So each item on the financial statement is calculated as the percentage of the total. This allows companies to compare performance from period to period as well as from company to company regardless of the size of the company. This analysis study trends with its own past financial statement, and the objective is to understand why changes have occurred and what to do in response to it. And this another type of analysis is what we call the DuPont analysis. This DuPont analysis acts as a search technique aimed at finding the key areas responsible for the firm's financial conditions, and it is used to analyze a firm's profitability and the return on equity. This analysis also allows management to view more clearly what determines or influences the return on equity and the interrelationship between the net profit margin, the asset turnover, and the debt ratio. So it breaks down the return on equity into three parts. That is the profit margin, the total asset turnover, and the financial leverage. So the formula for the return on equity is the net profit margin times the total asset turnover divided by 1 minus the debt ratio, or the return on asset divided by 1 minus debt ratio, or the return on an asset times the equity multiplier. What is equity multiplier? Equity multiplier measures a firm's total asset per ringgit of shareholders' equity. So the formula for equity multiplier is the total asset over the total shareholders' equity. This equity multiplier indicates how a company used debt in asset financing. A higher equity multiplier means higher financial leverage. How to improve the firm's return on equity? There are four ways to improve the firm's ROE. First, by increasing the sales without a disproportionate increase in costs and expenses. Secondly, by reducing the firm's cost of goods sold or operating expenses. Thirdly, by increasing the sales relative to the asset base or decrease the amount invested in the company's asset. Or lastly, by increasing the use of debt relative to equity, but only to the extent that it does not jeopardize the firm's financial positions. And the advantages of this DuPont analysis, it makes it possible to assess all aspects of the firm's activities in order to isolate the key areas of responsibility. It also allows management to view more clearly what drives the return on equity. And finally, the DuPont analysis provides management with a roadmap to follow in assessing their effectiveness in managing the firm's resources so as to maximize the return earned on owner's investment. However, there are also limitations of these financial ratios, such as the comparison with the industry average is difficult for conglomerates. It's not easy to make comparison. Secondly, the average performance as shown in the industry average may not be desirable. This the average performance or to be compared with the company's performance, perhaps not really a good uh, data to be taken as a comparison. And number three, the seasonal factors can also distort ratios. Number four, the inflation distorts the firm's financial statement. Number five, different operating and accounting practices make comparison difficult. And number six, it is sometimes difficult to conclude whether a ratio is good or bad. And last but not least, number seven, it is difficult to conclude whether a firm's overall performance is good or bad.